Nigeria's inflation is finally easing after months of persistent price pressures, as new data shows the inflation rate dropped to 16.05% in October 2025. While this marks a notable slowdown, the big question is what this means for households, businesses, and the broader economy, and whether Nigerians will actually feel any relief in the cost of living. Hello and welcome to MarketSquare, your go-to show for deep insight into business and economic trends. I'm Olaitan Adebayo, and today we're breaking down the key developments across Nigeria. Stay with us. Nigeria may finally be catching a breath in its long fight against inflation. After 2 years of relentless price surges, the reshaped household budget and weakened purchasing power, the latest numbers show a clearer and more consistent slowdown, driven by easing food prices and a stronger naira. For the first time in a long while, the data is aligning with what many Nigerians have begun to notice in select markets. Prices are not rising as aggressively, and in some cases, they're actually falling. The headline inflation rate eased to 16.05% in October, a multi-year low and just a single percentage point away from President Tinubu's long targeted of 15%. It's an important psychological milestone for a country that battled inflation above 25% not too long ago. This slowdown is being powered largely by food inflation, which fell sharply from last year's highs, and by former naira that has gained over 260 naira against the dollar within a year. But behind the encouraging headline numbers, the debate are heating up. Some independent analysts argue that the real inflation rate may be closer to 12%, suggesting that the economy will be heading towards single digits sooner than expected. The Central Bank of Nigeria is equally confident, pointing to what it calls entrenched disinflation as part of its justification for the recent rate cut in September. Across many markets, prices of major staples have dropped significantly. Even in non-food categories like fashion and household goods, prices have remained fairly stable. This would normally be the kind of news that reassures households, but the relief comes with a troubling twist. The crash in food prices is hurting the very farmers who produce these items. Many are reporting losses on their 2025 investment. With rising input costs and weak consumers' demand, some farmers say they are still selling below cost just to keep their operations alive. The fear among agricultural stakeholders is that the 2026 planting season could see massive withdrawals if losses continue. The government's own records also raise concerns. Nigerians spent over $10 billion on food imports last year, including food items that our country has repeatedly claimed it can produce locally. Between April 2024 and March 2025 alone, food imports rose by 11.6%. This influx of cheaper foreign goods is undermining local production, distorting prices and placing farmers in a difficult position. It's not just agriculture feeling the strain. The Manufacturers Association of Nigeria recently reported that unsold inventory in the manufacturing sector rose to 1.04 trillion naira in the first half of 2025, up from 896.2 billion naira previously. This suggests that the price slowdown may be more closely tied to weakened demand than improved productivity. Simply put, Nigerians are buying less. This trend could push certain segments of the economy toward disinflation, where prices fall not because things are getting better, but because consumers cannot afford to spend. It's a sign of weakened purchasing power, not necessarily improved market conditions. Even though inflation is easing, households still struggle with high costs in transportation, housing, education, health, and energy, areas that collectively account for the majority of Nigerians' inflation baskets. Electricity tariff, petrol prices, and diesel costs remain high, and these continue to feed into the cost of doing businesses. The positive inflation numbers could mask deeper structural issues, logistic bottlenecks, insecurity in farmlands belt, high borrowing costs, and climate-related shocks. While the Central Bank of Nigeria rate cuts has raised over cheaper credits, lending rates remain discouraging for most productive sectors. Nigeria's inflation picture for October offers a mix of relief and caution. The number shows progress, but everyday experience reminds Nigerians that the economy is not yet out of the woods. The risk now is making sure that this progress does not slip away. While inflation is easing, policy adjustments are shaping cost pressures across the economy, including fuel pricing. Nigerians' plan to enforce a 15% import duty on petrol and diesel has been postponed until the first quarter of 2026, following a government review of market readiness and domestic refining capacity. The policy, initially approved in October 2025, aimed to encourage local refinery, moderate fuel prices, and promote parity between imported and domestically produced petroleum products. Its deferment underscores the delicate balance policymakers must strike between industrial strategy and the realities of a refinery sector still ramping up production. The suspension has drawn mixed reactions from the oil and gas industry. Many independent marketers, including the Independent Petroleum Marketers Association of Nigeria, welcome the decision as a pragmatic intervention to prevent sudden fuel prices hikes and cost pressures. They argue that allowing imports to continue freely ensures competition, prevents monopolistic pricing by emerging domestic refineries, and maintaining a deregulated market environment. From the Petroleum Product Retail Outlet Owners Association also praised the move, noting that imposing a 15% levy at this stage of Nigeria's economic recovery could have been excessive. Industry stakeholders highlighted that the deferment provides emerging refineries, including Dangote and modular plants, with the time needed to stabilize operations without being undercut by cheaper imported fuel. However, by making imported fuel relatively cheaper than local alternatives, the suspension could reinforce import dependency and slow domestic value addition. While the decision may stabilize prices in the short term, it undermines Nigerians' broader industrial and energy security goals. Domestic refineries still ramping up production face a competitive disadvantage, giving larger international importers greater market leverage. Policy think tanks, including the Center for the Promotion of Private Enterprise, echo these concerns, framing the deferment as a threat to investor confidence and long-term refinery development. CPP emphasized that protecting domestic refining capacity is critical for energy independence, job creation, and fiscal stability. From a regulatory perspective, the Nigerian Midstream and Downstream Petroleum Regulatory Authority assured that fuel supply remains robust, sourced from both local refineries and imports. The agency emphasized close monitoring to prevent supply disruptions, arbitrary price hikes, or boarding, signaling a careful approach to balancing markets. The deferment alike the structural challenge policymakers face in Nigeria's energy sector, introducing tariffs designed to stimulate local production while avoiding undue supply disruptions. The government has sought to signal prudence by ensuring robust domestic supply, actively monitoring fuel distribution, and cautioning against panic buying. The story reflects a classic tension in emerging markets, the desire to accelerate industrialization versus the need to maintain affordability and market stability. In Nigerians' case, the decision to defer the 15% import duty appears as a pragmatic pause, acknowledging the current limitations of domestic refining capacity, while keeping the door open for a phased data-informed rollout that can align tariffs with production capacity and consumer welfare. For domestic refineries, it signals that policy support would need to be carefully collaborated to avoid creating competitive distortions. For policymakers, the challenge is clear: achieving energy security, industrial growth, and fiscal objectives without triggering market disruptions. As the government works to stabilize prices, attention is turning to how public funds are being managed to support long-term growth. Nigeria is facing a structural revenue challenge, and Zak Adedeji, executive chairman of the Federal Inland Revenue Service, has outlined what he sees as a path to reversing the trend. Adedeji emphasized that infrastructure investment, tax collection, and fiscal management must all be guided by economic returns if the country is to achieve sustainable growth. At the core of his argument is the idea that roads, ports, and energy projects should not be selected simply for political expedience or visibility, but based on their potential to generate long-term economic impact. This approach, he argues, would ensure that public funds are deployed efficiently, generate measurable returns, and support fiscal sustainability. Revenue mobilization remains central to this challenge. Adedeji highlighted the need to broaden and deepen Nigerian tax base, moving beyond the narrow focus on large formal companies to capture activity in the informal sector. The digital economic and high net worth individuals would largely remain outside in that tax net. He stressed that revenue collection must be fair, efficient, and sustainable, and noted the digital tools such as Tax Pro, the ETCC, and tax intelligence systems are helping the FIRS close compliance gaps and improve collections. Fiscal discipline is another key area of focus. Adedeji called for stronger adherence to budget rules, including debt ceilings, savings benchmarks, medium-term expenditure frameworks, and transparent procurement practices. Aligning appropriations with actual spending is essential to prevent recurrent deviations and underfunding of strategic projects. Infrastructure and economic diversification are closely linked in Adedeji's view. Investment in roads, ports, and other productive sectors should be data-informed, strategic, and aligned with private sector participation. Diversification requires not just capital, but coordination and the political will to make difficult but necessary choices. Institutional reforms, including greater autonomy and capacity for agencies like the FIRS, Customs Services, and budget offices, are also critical to sustaining growth. The numbers underlines why these interventions are very urgent. Nigerians internally generated revenue across 36 states and FCT grew 2.43 trillion naira in 2023 to 3.63 trillion naira in 2024, a 49.7% increase. Yet the distribution remains heavily skewed. Lagos, Rivers, and FCT dominate subnational revenue, while the bottom 10 states together contributed only 5.23% of total IGR. This highlights deep structural weaknesses in many states' economies and the over-reliance on federal allocations. Nigerians' future challenges is in two folds. At the federal level, efficient and strategic allocation of resources backed by robust revenue collections is needed. At the state level, there is a clear need to strengthen local economies, broaden tax bases, and implement policies that support sustainable revenue generation. Adedeji's recommendation points to a roadmap where data-driven investment, fiscal discipline, and institutional capacity building form the backbone of Nigerian strategy to overcome dwindling revenues and achieve a long-term growth. Beyond revenue reform, structural sectors like housing are also seeing new interventions aimed at closing long-standing gaps. Nigeria faces a staggering house deficit of over 28 million units, a challenge that has persisted for decades due to limited financing, high construction costs, and underdeveloped mortgage markets. Conventional mortgages tied to interest payments have excluded a significant portion of the population, especially those who are unable or unwilling to participate in interest-based financial arrangements. In this context, the strategic collaboration between the Securities and Exchange Commission and the Federal Mortgage Bank of Nigeria marks a potentially transformative step in addressing the country's housing shortfall while deepening financial inclusion. The partnership aims to establish a robust non-interest mortgage ecosystem leveraging Sharia-compliant financing structures such as Sukuk and other non-interest capital market instruments. By creating a regulatory framework for this financial product, the SEC intends to attract both domestic and international ethical investors into the mortgage sector. This approach is significant because it taps into a previously underserved market segment, enabling millions of Nigerians who were excluded from conventional loans to access affordable home ownership. The collaboration also signals a move towards long-term sustainable funding for the housing sector, potentially stabilizing mortgage finance and stimulating construction activity. From a broader economic perspective, this initiative could catalyze a virtuous cycle. Increased investment in housing finance can drive construction activity, create jobs in the building sector, and expand the supply of affordable homes. For investors, non-interest mortgage-backed security offer a new avenue for ethical investments with potential social impact, providing a way to participate in Nigerian housing solution without exposure to interest-based risks. The bright side of this development is particularly relevant, given Nigerians' persistent housing deficits. By expanding access to financing for lower and middle-income earners, non-interest mortgage could accelerate home ownership, reduce informal settlements, and improve living conditions nationwide. Moreover, as more ethical investors enter the market, the overall liquidity of the housing finance sector could increase, enabling larger-scale projects and potentially lowering the cost of housing over time. While challenges remain, such as ensuring transparency, operational efficiency, and risk management, the partnership represents a pragmatic and inclusive approach to a long-standing structural problem. If implemented effectively, this collaboration could serve as a blueprint for innovation, socially responsible financing in other sectors, demonstrating how regulatory frameworks and capital markets can be harnessed to address critical development gaps. And that's where we'll wrap up today's episode. From the latest dip in Nigeria's inflation rate to the government decision to delay fuel import duties to the renewed push for revenue-driven project selection and the fresh collaboration to reduce housing deficits, each development reflects an economy navigating pressure, policy shifts, and a need for sustainable growth. I'm Olaitan Adebayo, and this is MarketSquare. Thank you for watching and see you in the next one.